Hi, Jennifer. Thank you so much for joining me today.
Thanks for having me. I'm excited to do this.
Yeah, so let me introduce you to everybody that's listening in. So Jennifer Buckholz has been one of my favorite business partners as a lender. She's a senior loan officer, and she's with CMG Financial Home Loans. It's CMG Home Loans, excuse me.
Correct. Yes.
Yeah. And so we do have in our link today how to get a hold of her, because I know that after we're done here, you're going to want to reach out to her. And of course, you do loans and refinances, obviously, but there's one loan in particular that I am fascinated about. My own personal family is taking advantage of this. I have a lot of my friends that we've signed up for this loan program, and I'm just trying to share it with everybody else, especially today, because today is so driven by the interest rate. And that loan program is called the all-in-one loan. So
Yes.
I'm excited to hear more about it from you. And so why don't we just dive right in? What is the all-in-one loan?
Yeah. And, thanks, Rosie, for having me. But you're right. In today's environment, it's really great to have some options on some different lending types of loans. And we are a full service lender. We offer everything out there. And the all-in-one is just a niche product that we have that I think is a great financial tool and an option for people.
Mhm.
So the all-in-one is a first lien home equity line of credit, and it's combined with a sweep checking account.
Okay.
And so if you look at today's traditional lending and traditional banking, what that looks like is you've got a consumer takes a paycheck and it goes into their traditional checking account. It sits there, they earn point nothing on it. And we as consumers have always accepted that because we need the liquidity of those funds to pay our monthly expenses. One
Sure.
of those is our monthly mortgage payment.
Everybody's familiar with how that
Yeah.
works.
And it's all based on an amortization schedule. It's based on the favor of the bank on a predetermined agreement you make with the bank on paying interest for a 30-year term.
Mhm.
So the all-in-one is not rate driven, which is one of the reasons why I think it's such a powerful tool.
Yeah.
It's cash flow driven. And
Mhm.
so I think it opens up a lot of opportunities for people that are so stuck on what the interest rates are doing today.
You know what's happening in our world right now? You're in the middle of it with me.
Mhm.
I will share with the audience that right now, the sellers are not really wanting to move right now because they most likely took advantage of COVID artificially driven down interest rates to get the economy moving. And so they
Right.
may have locked in on a refinance or a purchase at like 3%. Well, that's not coming back anytime soon.
It's
That was
not.
to get people out of their house, and start spending their money on homes. So, and it worked in droves. So now we have those folks that don't want to necessarily move and have to pay a higher interest rate. That's why I really wanted to present this to our audience,
Mhm.
because you are turning this upside down. It's not driven by the interest rate. Interest rate
Right.
matters, of course. It's not driven by that. So tell us more.
So yeah, the all-in-one, it's really about being kind of having some financial freedom that you're the bank of you. So your lazy money that's not being utilized for your bills is actually offsetting your mortgage balance to where you're now paying daily simple interest based on the average daily balance. And so when rates are ugly, I mean, they're ugly all over the place. There's no doubt about getting around that. The problem is that if people are waiting for that interest rate to drop back down to a 3.5% rate, what's going to happen? The house prices are going to come up.
House prices are going to come up. And if we have a 3% interest rate again, it's because something horrific has
Right.
happened to drive the
Exactly.
economy again. And we don't want that even to come into our world either.
Right. Exactly. So, we've got a tool, and I'll share that with you here, but we've got a tool where we can actually compare what they currently have or what they can get on a purchase price to the all-in-one. And I think it's really important to understand that this loan is very, very specific to individual cash flow. It's a
Mhm.
financial tool where it depends on what your take-home pay is, what your monthly expenses are, what your personal cash flow is. And so we can actually drive a scenario to where we can put in all kinds of hypotheticals. We can put in factual data that will kick out a result to see comparing to that 3.5% rate or today's current market rate.
When I try to explain this to folks, I understand it because I have sat through seminars with you and I've done it myself. So I really think it works best if we can show our audience a fictitious person and how that will work for them. But of course, you're available to talk to them and customize it to their situation on a one-on-one private basis. So can we just jump to that part?
Yeah, absolutely.
I think we froze. It happens live.
Are we good?
We are good now. We were frozen for a bit. Okay.
Technology.
I
Okay.
can see your screen now.
So the thing I want to really reiterate is that, you know, we are a full service lender. This is our niche product. And the all-in-one is just a great option for people who are stuck, or people that are focused on paying their home off early, having access to the equity of their home, and having the flexibility to be the bank of you so that you get to control it. So I'm going to run us through a simulation. And this is something that I do with absolutely every client, because I think it's really important that we actually see specific results to their situation. So we're going to do a new simulation, and we're going to compare this to a new primary home purchase.
Perfect.
Okay, so we will say it's an $800,000 purchase and a $640,000 loan balance. Okay. And let's just compare it to today's rate environment of about 7.25 on a 30-year fixed. Oops. Let me go back. Sorry.
It's okay.
Okay, so this principal and interest payment right here would be an amortized payment based on a $640,000 mortgage balance. So this is principal and interest. And we all know that it's about the 16th year before you're actually paying more principal than you are interest on an amortized loan. Okay. So again, as I had mentioned, this loan is driven by cash flow, not interest rate. I'm not going to say rate doesn't matter. Rate always matters. But this loan is driven by the cash flow of a client. Right. So let's say that we had a $10,000 paycheck that hits the account on a monthly basis. Okay. And then we had a co-borrower who had $2,500 semi-monthly. Okay. Okay. And then let's say that this client had a $15,000 annual deposit from a bonus, maybe. Okay. The reason I put the frequencies in is important because that's how it's hitting the account. It's hitting the checking, the mortgage balance at that frequency.
So it can be amortized properly on that end.
Correct.
Okay. And I think that's a pretty standard scenario right there. Our average.
It is.
Yeah.
It is. So again, data in, data out, right? So we want to make sure that the clients have accurate numbers coming into this. So I kind of asked them to do a little bit of homework. I want to know what your net take home pay is. And I also want to know what your monthly expenses are. And expenses don't show up on your credit report. Those are bills. Those are installment loans. Those are credit cards. But there's a lot of stuff that happens in life outside of what's actually reporting, like your grocery bill or, you know, your select soccer for your child. I mean, all of that stuff is real life expenses that we need to cash flow. Right. So we're going to say that this family has $300 weekly grocery expense. And we're going to say that they have a $700, say it's a car payment. Okay. Outside of the car payment and the groceries, I'm going to give them $4,500 of other monthly expenses. And what that is the cable bill, insurance, HOA dues, things that are actually happening on a monthly basis.
Mm-hmm.
So on a house that's 800,000, I'm going to guesstimate that taxes are 10 grand a year. Depends on the county, depends on where we're at. But we're going to say that in the state of Washington, we pay them semi-annually. So it's $5,000 every 6 months.
Okay.
And an insurance premium of $1,000 a month.
Sounds good.
We've already hit them for their house payment. This is already budgeted into their cash flow. These are outside of the house payment.
Okay.
So first thing I'm going to do is I want to talk about the interest rates, but this client on the highest margin, and we'll get to that in a minute, would save $643,000 of interest expense and pay their house off in 8.8 years.
Hey, did everybody hear that? Instead of the traditional mortgage on the right-hand side of, you're going to pay it off in 30 years. And it's because of the amortization and not having using it as a bank account where you put the money in and you're using the money and it's coming out and it's continually buying down the mortgage. And that's why the interest rate is not as important. It's not driving it. Yeah.
So exactly. And to that point, so like I had mentioned, this is a first lien home equity line of credit that's combined with a sweep checking account. So this client's paychecks are going into that checking account. And at the end of the business day, it sweeps over and lowers that $640,000 mortgage by whatever was deposited into that checking account.
Immediately.
Now,
Yeah, immediately.
Immediately that day.
Mm-hmm.
And now that interest is being calculated on the lower mortgage payment.
Mm-hmm.
But we also know that we have monthly expenses. $4,500 of traditional monthly expenses. So you need access to those funds. So what happens is it's a full service checking account. It's got bill pay, check writing ability. It's a full-fledged checking account. What happens is when that check hits that, or when that expense hits that checking account, it pulls for whatever is needed to cover only that bill. And then it's pulled into the checking account and you're utilizing all the money that you've not yet needed is still offsetting your mortgage.
And it's a regular insured bank.
Mm-hmm. It is. It's a full service. Debit card use, check writing ability. You can link it to your external account so that you can transfer back and forth to your current local branch.
Mm-hmm. So some people may say, well, I've got my 401k, I've got my retirement in stocks and diversified. What do you say about that? Are they supposed to move everything over?
No. Keep your retirement where it is working for you, your stocks where it is. We just want your cash flow. We want your paychecks and we want your expenses to flow through this account. We will also talk about where you park your lazy money. Let's talk about the interest rate real quick.
Okay, tell me what lazy money is.
The lazy money is the money that's sitting in your savings account earning point nothing.
Understood.
Yeah. So the interest rate is made up of two components. There's a margin and an index. The margin, I'm going to reduce this to 3.5 because that is par pricing. The margin is fixed for the life of the loan. That will never change. The index is based on the CMT index, which is the constant maturity treasury rate. And that goes up and it goes down. And it's up. It's at a high at the moment. It will come back down. I can't tell you when, but it will come back down. So what you do is you add the margin to the index to get what's called a fully indexed rate. So this is simple interest at 8.91.
Mm-hmm. So that's right there scares people initially until they really get the concept of the all-in-one, that you're actually paying off your loan faster.
Correct.
And it's not going to matter as much in the end because you're saving $656,000 in the end. You're not spending more, you're actually saving more. Is that accurate?
Correct. Which you're not spending because you're not paying it, right? Mm-hmm. So when you look at a 30-year fixed traditional loan, 7.25% rate, you're going to pay $1.5 million in payments towards that property. towards that mortgage,
after 30 years.
$931,000 of interest expense.
Yeah.
By using the cash flow, and this scenario that we've put in there is pretty traditional. It's a pretty common scenario. With this cash flow, these people are only paying $275,000 of interest expense.
Love
so
that.
The problem with the 30-year fixed mortgage has very little to do with the interest rate. The problem is that you've made a predetermined agreement with the lender to pay interest for 30 years. It's that you've got a predetermined amortization schedule.
You're locked
and
in.
The lender's going to get paid first.
Yeah, they're locked in no matter what. With the all-in-one, it's going to be fluctuating depending on how much money you put in that all-in-one account, which is why I think the best candidate for this loan is somebody who actually makes the money. Can you explain that better? I won't speak for you. Who is the best client for this?
The best client for this loan is those that are cash flow positive. I've had a lot of very successful moderate income people on this loan, and I've also had a lot of high income earners, but they tend to spend more money. It's really about your cash flow. It doesn't have a W-2 attached to a minimum income. It's about how much are you not spending or how much of your income are you saving. The other part, we'll park the money in there, is people that have a lot of money sitting in a savings account for a rainy day that's not working for them.
Lazy money.
So let's get back to this interest rate, and I'm going to show you a historical graph. This is a 25-year snapshot of the Fed fund rate, the traditional 30-year fixed rates, and the CMT. Historical average is 2.025 for the CMT. We are at 5.41 today. As you can see, when the CMT goes up, it comes down. It's just cyclical. Okay, so we've been on an uphill cycle at the moment. So what we do is, as the rates drop back down, the interest rate drops with the all-in-one. Where a traditional 30-year fixed, you're locked in at today's rate on that. Now, yes, you can buy the house today at maybe a higher interest rate, and we refinance, and we actually do that as a rate rebound. Those that are actually purchasing and want a 30-year fixed. But this is an automatic flow that when the rates drop, your rate drops. Okay.
Are the rates going to drop in your opinion?
In my opinion.
Yes. Not as low as 3 or 4%.
We're not going to see 3%. We're not going to see 3.5%. I do think that we'll see some corrections in the interest rates. There's a lot of very smart economists out there that are reporting on this, and I think that they will.
I'm following them too, and they just don't know when. We're trying to remedy the inflation before they can bring it down again, and we have a little bit of chipping away at inflation first to get a hold of it. Yeah.
The one thing though, I think we all can agree on though, is house prices are not going to drop.
No.
So
yeah, no, they're not. And when the interest rates drop, the prices go up.
Right.
Yeah.
So buy the house now. Get the house at today's market price. When the rates drop, whether it's the all-in-one or a traditional 30-year fixed, we can remedy that, right? The all-in-one just flows down.
You can, because the all-in-one, you don't have to sign papers and refinance and spend money to refinance. It's actually just doing it in a natural flow.
Correct.
I like that too, because some people that want to do, for example, home equity line of credit, they got to spend the money to get their own money.
Right.
You don't have to do that. Now
and they still have that first lien front mortgage, right? The first lien is still there. So you're making 2 payments. So
this made way more sense than doing that. Also, I have clients that have an existing home, an existing mortgage, and they want to buy another home. Does this work for them as well?
Absolutely. Yeah. We can do 10% down payment on a purchase. We can do refinances, where I've got a lot of clients right now that are actually refinancing onto the all-in-one, their current home so that they have access to the equity to purchase a second home or an investment property or something to utilize the equity. So
Mhm.
that's probably one of the most powerful things, in my opinion, outside of saving the interest, is having access to that equity. So when
Mhm.
we look at this scenario, we would have to get a 2.545 rate APR to pay the equivalent interest on the all-in-one. And we're not going to see this, and we've never seen it. But the point being is that when you've got a financial tool like this, where you're actually chipping away at the principal balance, paying daily
Mhm.
simple interest based on the new balance,
Right.
you're gaining more and more access to the equity. So when
And
we look
it's money.
and your own, right. And so when we look at this graph here, $800,000 purchase, 640 loan amount. They actually put it like this. The
Okay.
blue line is the line of credit. The green line is a 30-year fixed mortgage. We know exactly how much you're going to pay, how long it's going to take, and what the cost of that home is truly going to be. The
Mhm.
black line is the all-in-one. You have access to the equity of your home from the black line to the blue line for the life of the loan.
And then you can explain that to people when they call you, and it'll be custom to them. It'll make more sense too, since they'll know the numbers.
Correct, exactly. So the blue line starts taking a pretty deep dive at 10 years, and it starts reducing the line availability because we do want this paid off in 30 years time frame.
Mhm.
But up until 30 years, you've got access from the black line to the blue line to draw for the equity of your home improvements, emergency funds, vacations, investment
Investment.
opportunities.
Mhm.
Right, exactly.
So I
So
think this is a good program for investors as well. They
mhm,
see that house that comes up that is too sweet to pass up. Now they have to quickly, traditionally do a home equity line of credit or do hard money lending.
right,
This, they can just pull the cash without spending the extra funds, just pull the cash that belongs to them with no extra fees.
exactly, exactly. And when you look at how a traditional 30-year fixed mortgage works.
Mhm.
So let's give this borrower 24 months into their home.
Okay.
On our house, they would have paid, or on our loan on the all-in-one, they would have paid $103,000 worth of principal balance down.
Mhm.
On a traditional amortization, it's $12,852.
Right.
So that works for somebody that says, I'm just going to sell my house in a couple of years. I'm going to move. That's great. Look at how much more you'll walk away from the closing table with.
You have more money.
So as you're paying this down, you have access to the equity for whatever it is that you need it for.
Mhm.
So I talk about lazy money. If somebody had, say they had $25,000 sitting in a savings account, because we all need money for that rainy day, right?
Right.
That money's not working for you if it's liquid traditionally
In a traditional bank account,
in
but
a traditional bank account.
now you'll put it into the all-in-one account, and what's going to happen? Dun, da, da, da.
Paid off in 8.3 years, saving $683,000 in interest expense.
I
Then when
like
you look at the pay down graph,
Mhm.
do you see the big dip where it drops right at month 2?
Mhm.
That's your $25,000. And again, you have access to the equity of your home from the black line to the blue line. So that 25 grand is liquid.
Mhm.
So we can do this for refinances. We can do it for purchases. We go up to $3 million. We go, I'm licensed in 24 states. This loan does not have county loan limits, which is huge. And we can do primary homes, second homes, and investment properties.
I think you summed it up pretty darn well. I can't wait to share it with everybody. I'm a
Yeah.
big fan, a raving fan of this all-in-one, and you are amazing to work with. You've taken great care of my clients. So thank you, Jennifer.
Thank you. Yeah. I
Okay.
did, I think I shared with you the video that
We'll
will
put
be
the
in the
video in
link.
the link and how to contact you in the link. And I encourage everybody to give you a call directly so that they can figure out how they can start saving money and paying off their loan faster.
Sounds great.
Okay, thank you.
Thanks, Rosie.
How do I stop recording?